Hey there, everybody, and thanks, Dave, for having me on. It was interestingly enough, it was about a year ago exactly that I talked about this particular methodology. So fascinating. We'll see how it goes a year, almost exactly a year to the day. I'm going to be talking about a ton of numbers. I do my best to give you the actual numbers. All trading costs are built into anything I talk about has real trading costs built into it, stuff that I've seen in the real market. So yes, I'm going to give you some numbers, but again, I do the best I can to give you something that's will happen in real life, hopefully going forward. But of course, these are meant to educate and they're not actual trading numbers. Okay. First of all, anytime someone speaks, you want to think about who is this for and who is this for today? What is my presentation for? Well, obviously there's a lot of different traders out there and everybody has different things that are important to them. Now, some traders like the hot new thing and there's value in that, right? Because maybe something that's just come out or something that's really good for this particular market. Maybe it didn't work in the past, or maybe it wasn't around in the past, right? We've had so much tech change in the past year or even 3 or 4 years. So there's nothing wrong with the hot new thing on one hand, but this is not a hot new thing. So just keep that in mind. Some traders like to dabble in this and try something on that and move from this system to that system, or maybe build a portfolio. Again, this isn't that. This isn't an adaptable system. This isn't something that's going to change. This isn't something that you need to optimize. It isn't something made at all for change and for looking for something that's absolutely brand new. So keep that in mind. Other traders, and I get a lot of emails, probably no one here or no one on the recording, but I get a lot of traders saying, listen, times are tough. I only have $100 or $1,000. What can I do or what should I do? Again, this isn't that, right? There are ways to do that. There are a lot of great systems that don't need a lot of money. Forex was famous for that for a long time, but this isn't that either. This is something much different and much more for the long term. So again, if you're looking for any of that, hopefully you'll still listen, and I think this will be interesting, but keep in mind it's not what it was built for, okay? What is it for? Well, it was designed to never, ever, ever change. That's really when I came. Now, I do my research. I'm very slow to implement. I'm very long to test. And I wanted something, this was years ago. I got tired personally of the hot new thing. I got tired of constant adaptability, or how do I change into something that works exactly at this moment. I just got tired of it. So this was designed to not be that either. I don't want any of this to change. It is designed for the long term. It's something to consider that you'll trade today and next month and next year, okay? So there is a special way to develop those type of systems, and we'll go over all the details of all of them, and I'll try to explain that to you. But there's a huge difference in the design of something that's going to last forever and something that's going to last the next quarter or the end of the day, like a zero DTE option, okay? Now, that means it has to be designed on principles that are true going forward, right? You can't have something that only works today or last week or in 2025 and then expect it to work when the market changes. I mean, stock market has changed dramatically just today based on the news that's coming out, right? So the stock market, in fact, in 2025 has been crazy. There are tons of different methodologies that all could have had periods of winning in 2025. Well, again, this was designed for the opposite of that. This was designed so in 2025, no matter what comes out, this portfolio hopefully will power through, again, for the long term. Now, YOLO has a very different connotation in trading, especially in 2020 and the Robinhood rise and fall and all the meme stocks in 2021. YOLO means I have a certain amount of money, I'm ready to lose it. Well, this is YOLO completely inverted, right? As Charlie Munger says, always invert. Well, you only live once, so why not trade something long term? So why not commit? Why not trade to something that will be around hopefully in a year, 5 years, or 10 years or more, right? If you only live once, why mess around with something that's going to fail, right? Just another way, right? A mindset inversion. And that's what I want everyone thinking about as we go through all the details and all the numbers. And again, as I mentioned, it was almost exactly a year ago today. Personally, I love that, right? So what do I talk about? Things that I personally like. I don't like always changing systems, new. I love to go back. In fact, I just read James O'Shaughnessy's book from 2006 and put together some portfolios and did a bunch of testing on that. I love that. I love old trading books. I love to go back and say, okay, this was written in 2010. Does it still work? To me, that's extraordinarily valuable. But again, it's for the long term. So anyway, this portfolio isn't going to be a one and done. I've been tracking this ever since I talked about it last year, and I'll continue to track it. I want to track this for the long term or until it just utterly fails in front of everybody's face, right? So we'll see how it's done, okay? Well, then obviously, right, now that we've got our mindset in the right direction, hopefully, how do you then make something long term? I hinted that it's a very, very different way to think. And we'll talk about that here in a moment. But a spoiler alert is that you need something that's going to be true, which is a timeless principle. Okay, you have to have something that's not going to go away. So it takes a lot of thought to think about, okay, well, I like this entry. Is it going to go away? I like this exit. Is it going to go away? So that is very, very important. And I think we've got that in what's to come. We'll see. But there's another way to make something long-term, and that's multiple time frames. You can take the same thing and build it out into different time frames, and all of a sudden now you've got a little bit of diversification, which seems weird, right? Diversification usually means completely different things and completely different assets, but it's not exactly that. Sometimes diversification can be just changing the time frame, hence the title of the talk. Okay, so let's start building something long term. Well, what's the longest term thing that we've got? It's the stock market, right? It's 7 to 10% per year forever, right? To what we're told. And here is this chart from TradingView, goes all the way back to 1993, right? And you can see with now from 2000 to 2013, there's that dead zone, but with a very, very long-term horizon, what do you see on the screen, right? You see upwards from left to right, especially in that 2015, right? Let me look at that parabolic move. And you see, which TradingView nicely calculates that for us, from all the way back to 93 to 2025, April, to 1,169% gain. So how can we harness this? This is not a short-term thing. How can we harness and get on board and get something like that that's going to last from 1993 to 2025? Okay. Well, to do that, go back to that chart, right? What if we shorted in 1993 and held it, right? I mean, that's zero, right? You go to zero. So you have to remember, and I've said this for trading systems, and I'll say it right now, especially for the system we're building, the long side and the short side are not the same. And a lot of traders that I admire, like, and respect, and love their stuff, but they are adamant about the settings have to be the same on the long side and the short side. And I adamantly, respectfully disagree, okay? Especially if we're gonna build an index system, especially if you want something long-term. So they're not the same. So all of these systems based on stock market / index, that I want those to ride the long bias. We saw the long bias. It's there. It doesn't go to 1993. It goes back to the 1900s, right? So I don't want to worry about this system. I don't want to change this. So why would I go short and worry about how long is the dip going to last, or are we going to just go parabolic up again? So there's no short, at least in the first systems that we'll look at, right? So long-term, long bias, that seems to make sense. Now, that said, you could just buy and hold the stock market, yay, 7 to 10%, whatever that number is. But I wanted leverage. I wanted to hopefully, maybe, possibly make more than that, than just buying and holding. So where do we go for that? Well, we go to futures, okay? Futures gives us tons more bang for our buck. We can get all this good stuff, this long-term bias, we can get all that, but we can get more power behind our trades. Just one contract of the ES, which is the E-mini S&P, of course, but just one contract gives us so much leverage. So that's where I went. This is a futures system made for futures, okay? All right, now let's build a system. System number one. If we want something to be long-term, where do we start? How about on the daily chart, okay? You can even go weekly or monthly, and I have systems for that too, but daily chart, okay, fine. What system are we gonna use? Again, go back to your old trading books, right? Guess what's old? Dave knows it, I know it, the RSI 2. It's very famous. Use the RSI indicator with a length of 2. It's been around for decades, and test it out. I've run so many tests on this system on various time frames. It produces profit, which quote unquote means it works, right? So how are we gonna do it? Well, what's a very effective way to get in? Buy the dip, get in on a pullback. So we're gonna enter at the open. Here are now the trading rules. Enter at the open of the next bar when the RSI 2, comes out of oversold. Okay, this is completely different, and the next system will be different. We want this to go into oversold, right? So the market is going down. Our bars are going down. Well, everyone says don't catch a falling knife. What we're going to in the next system. But okay, so we won't catch a falling knife. Fine. Thank you for the advice. So this has to come out of oversold. And we'll see that on a chart. So it goes down and it can stay there, maybe for multiple days. But then we need it to come up. Why do we do that? Because if it comes out of oversold, what do you think? Maybe it's going to go up now, right? Maybe the hard times are over. And again, we're going to add, well, not even again, to introduce, we're going to add a filter. I like filters. Hopefully you do too. But I like to keep them simple because you can go absolutely crazy on filters, okay? There's so many filters. There's dozens and dozens. This is just the 100 simple moving average. That's fine. Could it be 50? Yes. Could it be 200? Yes. Could it be 150? Yes. Okay. But we want it to at least to be bullish as much as we can discern. So we want it above. We want it to go into oversold, and then we want it to come out. Now, how do we get out? Well, we're totally riding the momentum. What does the stock market do? It bounces back after a pullback, right? That's just fundamental. You see a red day, and then a green day will follow. Just makes sense. So we're exiting at the open of the very next bar, once it goes into overbought. And the overbought threshold is just simply 70. So when it gets above 70, you don't get out then. You wait all the way overnight till the next one, which is scary. But you'll see the testing. There is no stop loss. Now, this gets out pretty fast, but if it doesn't get to 70, if we come out of oversold and we take the trade and it lingers, yikes, right? There's no stop loss. So could be a problem, but it also should be reasonably high percentage. All right, so here's a bunch of trades. See, now we're into 2025, and you can see when it's above the 100 simple moving average, you have all sorts of trades. And here's a terrible example, right? This is the worst. We're in a trade and it's leverage. It went into oversold, it came out, we got into the trade, and it just fell. It never got into 70 until there. That's a loser, right? In 2024, this was a shaky period. Then this was a little twitchy period here. We got into another trade. It went down, it came back, but we didn't ride it all the way up. The system stinks, right? Once it was going our way, this system doesn't stay in. It gets out when it gets above 70. So we're idiots, and that's about break even. And then did it again, although I'm glad it got out here. But normally it's go into oversold, snap back, go into oversold, snap back, go into oversold, snap back. And notice this is 2025, it's done nothing. It never went into and came out of while it's above our filter. So this is doing nothing. All of this down, the worst quarter in 3 years, this system absolutely did nothing. And here's the trade in more detail. This bar, it goes down into oversold. This bar, it comes out. Enter at the open of the next bar. This bar, it went to 70, out next bar. Same thing here. Oversold, comes out, get in. Above 70, get out. Pretty simple, right? Absolutely. I've code for this, simple code, but obviously this could be traded by anyone. Just click a button and just look once a day. When will this strategy do well? Well, when the trend is strong, but there's a momentary pullback, it's going to be great. When buy the dip is working perfectly, this is going to be great. And a lot of times it does. That's where that phrase comes from, buy the dip. But it also works when ATR is increasing, right? Because if the stock market is moving a ton, by the time it gets to oversold, we will have made a lot of money, right? So if it gets to 70 overbought, but it hasn't moved very much because the ATR is small, you're gonna get small winners. But what's cool though, it is kind of adapting to the market, even though I said I don't really care about that. As far as system design, I do care about it when I'm in the trade. If the market is super volatile, I'll take the big win, that's fine. Of course, there is a possibility of losing too. When we'll do poorly, when the trend is shaky, when it goes in oversold, comes out and then goes back into oversold, right? That's terrible. And when buy the dip is not a buy the dip, it's a beginning of a drawdown, right? That said, you would think 2022 is bad, but as you may have heard last year when you were here, I'm sure you were here. Here's 2022, 2023, 2022. And there's 2 winning trades and a nice winning trade here. Now you would have spent most of that bear market not trading, but you would have had 2 winners. So this kind of has protection in a bear market, which is cool. Now let's look at the numbers that I told you about at the top. Trading 1 contract on a hypothetical 20K account made 89,000. Look at that profit factor. It's unreal, right? Unreal. The drawdown is a little misleading. That's a great drawdown number, but this particular software called Portfolio Architect, which I love, it only counts close to close. So keep that in mind. Intraday it would be higher. Okay, just letting you know. TradeStation will calculate that for you. The drawdown, there you go, 8,800 absolute drawdown. That means when it went below 0, assuming we started at a certain point, how far did it go below our start point? 119 trades, and there's our high winning percentage, 78%. Here's what this looks like if you traded it by itself. I took this all the way back to 2002. That's a huge testing period. Didn't do great in 2002, as you'd expect, but man, look at that. It goes on a run of winning years. Again, these aren't huge. This is the 4,200 threshold level, all right? And we're assuming a 20K account, so just basic move, right? Nothing huge, but consistent. I mean, that's a lot of years from 2003 to 2017, no losers. Back-to-back losing years, yikes, but tiny ones, very tiny losers. And then, of course, look when the ATR increases. I mean, on a 20K account, we almost made 100% in 1 year. Massive. And then these, right? Also very big years. Nothing in 2025, as I said. Okay. Here's your equity curve. Again, 20K account. It's about almost 400%. Almost 400%. Of course, you saw in 2002, of course, it went down a little bit. But that is a steady climb for a system with no stop loss, right? Okay. System number 2, though, I didn't like those losing years. Can we do better? Well, I want an even higher win rate, so let's do this. Let's stay long term, but let's go down to the 240-minute chart. Why? We'll get more trades. More trades maybe can offset whatever's happening on the big daily chart. And we're going to use a different indicator, diversification. CCI is very, very similar to RSI too, so I like it. I like them both. So we're going to use that instead. And we're going to catch falling knife. We're going to enter at the open of the next bar. When the CCI indicator goes into oversold at minus 100 threshold, as long as it's above, again, the 100 SMA, right? This is different from the daily because it doesn't wait for it to get out. It waits for it, it just goes right in, right? When you go in, you start taking the trade. Here's the interesting part, and this freaks people out. To take profit, you calculate the ATR based on the last 14 bars, and you'll 1.1 times the ATR. So if it moves 10 points, you're gonna get out at 1.1 times 10, right? So a little over 10 points. The stop loss, however, is 9x. It's essentially not having a stop loss. It's an emergency stop loss only. Again, we just use a simple ATR, the default. It's 9 times. So again, if it's a 10-point stop loss or 10-point ATR, multiply by 9, it'd be 90 points. Wow, right? That is negative, what they call negative reward to risk, and people freak out about that, but I do not. We'll see how it works. I do put a time exit on it though. What if it's just going sideways and doing nothing important? Well, at some point I just want to get out, okay? So this is about 12 calendar days. Again, trading days would be several more, but it's just 74 bars, 240-minute bars. And if nothing has happened, which we'll see on the chart, nothing has happened, you just get out. So now we have 2 time frames, right? Let's take a look. Here are a bunch of trades. This one was scary. Way back, this is 2025 here, so 2024. You entered, it went into oversold. We got in and look at all that, right? But it wasn't 9x our ATR. And then it finally got out at our tiny little profit. There's our 1.1x. There's our 1.1x. Again, this looks bigger when the ATR is bigger, right? This is, again, based on the average true range. Win, win, win. And this is the most recent trade. Lasted forever. It lasted all those trades where we got in December, mid-December, and it just languished and languished, and then the time exit took it out. We could have maybe gotten our profit, but it took it out, and I'm glad it did because you see what happened in 2025. Again, you don't take trades if it's below our filter, okay? Again, if you want to see a trade, it went into oversold, and we immediately get in the next bar. We don't wait for it to come out. It looks like we waited, but we didn't. This was oversold, and it's going to hit the entry automatically at the open of the next bar. Of course, it hit our 1.1 and we're out. So yay, that was a winning trade. All right, will this strategy do well? When the trend is strong and the buy the dip works, same thing here, right? It's going to be exactly the same. It's going to work great. When the ATR is increasing, it's going to work great, right? It's going to work really great, as we'll see. When we'll do badly, when the trend is shaky, we saw an example of that. It goes down and down and down and down, going to our 9x stop, yikes, right? And buy the dip is not buy the dip, it's buy the loser, right? Or this will also not do well if ATR goes to nothing, right? What's going to happen in the future? Do you think average true range is going to go down to 0? People are going to stop trading? People are going to stop being interested in the S&P 500? Do you think that's going to happen? Not so sure. All right, here's the report. Again, here are the numbers. Trading costs are included, 2002 to 2025, 1 contract, again on a sample 20K account. Big number here, huge profit factor. Drawdown again, it's close to close. And look at that win rate. It's crazy. Now again, the testing goes back several years, and I've been watching this trade on my computer now for a while, multiple years, right? I haven't changed it since I talked about it last year, and I tested it years before that. It stayed, right at that win rate. So interesting, right? But you'd expect that with a negative reward to risk. Now, how does that look over time? 2002, you'd expect it to do badly. 2008, it survived. Crazy, right? The worst bull or bear market of our lifetime, 2008. 2009, it did thrive. Losing year 2018, huge drawdown in 2018 that nobody remembers, seems like. And then the ATR increased, and look at this. Did not do great in 2023, surprisingly, but roared back in 2024, right? Again, sample 20K account, we're over 100%, hypothetically, and almost 100% here. And again, it hasn't traded in 2025. Okay, here's your equity curve on a sample 20K account going back to 2002. We're up about, not quite, almost 700% overall as time goes on. Is this a long-term system? Was the previous one? I mean, you have to decide. But I wanted something else, right? I don't want buy the dip, right? They're too similar. I need something that pops when the trend pops. So this is system number 3. I went down all the way to a 5-minute chart. So this is essentially a day trading strategy, right? But I didn't want this complicated. I just wanted to be there when the trend hits. I don't care how perfect this system is. It has one job to do. It's supposed to give me the trends when they break out. That's it. I don't expect it to be great, okay? That's the role that this particular player has to play in our team. 5-minute chart, quick trends, the RSI, back to the RSI, but we're doing it totally differently. I didn't even optimize it. It's a default setting of length 14. When the RSI goes up into overbought, so this is a trend moving up. We're not going to play the reversion. We're going to go with it. On the 5-minute chart, if it's overbought A trend is starting, let's get in. And let's go for a very positive reward to risk. Our profit is $1,000 per contract. Our stop loss is $400 per contract, right? So we have an actual number. It's not ATR based. Well, shouldn't it be? No, not to my testing. It should not be ATR based for this one. So $1,000 per contract, $400 for the stop loss, okay? Obviously the win rate's gonna be pretty poor. Now we have 3 time frames. We have different reward to risk on all of these, right? Or at least in the, we have positive and negative. We have now trend following and we versus buy the dip. We're kind of getting diversified. We have different time frames. I wonder how it's going to work out, right? And here are some trades. On the 5-minute chart, again, we're trading the ES.D. You've seen that on all the slides, which means you're only trading the regular trading hours. Everything's going to 24 hours now, but this one does not. Hopefully that will continue into the future. I think it will. But anyway, it goes into overbought and it buys, which is crazy. I've missed all that. It's okay. And immediately turns around. Oh, I expected that, right? Stupid system. But over here, it goes into overbought and it keeps going. We got a huge winner, right? $1,000. Then it did it again, same day, and it fell. And then obviously here, never gets there. So you don't trade. Okay? Very, very simple. Just give me a trend, get on board, and hopefully we capture a nice chunk of that. When will this do well? Short, sharp trends upward. Absolutely, that will be fantastic. Or very bullish market, just in general. Just it goes up, makes 1,000. Pops back down for a second, then goes back up again, makes another 1,000, right? This strategy has huge wins when things get hot. Not so great when things aren't hot, we'll see. When we'll do poorly, market is listless, like not even trading and not even doing anything and definitely not breaking out. Or whipsawing, which you saw on the chart, it goes up and then immediately reverts. A mean reverting or a bearish, either one. Mean reverting is probably the worst, right? Down markets aren't really that bad in the fact that we just won't take trades. So actually a terrible bear market isn't the worst, but a whipsawing one is. All right, going back to 2002, again on a 20K account, it's the ES. Well, that's a nice amount of profit, but look at our profit factor, right? When you trade this way, profit factor dwindles. That's getting awfully close to 1. That seems like kind of a poor system, right? But the drawdown, and the drawdown is huge compared to the others, and that's just close to close, okay? Absolute drawdown is also a little bit high, and our profitable trades are down to 33%. We would expect that. Again, trading costs are taken out. Here, annual returns, and they're all over the place, as you can see. 2002, terrible, right? Didn't like the bear market because there are a lot of false starts, loser, loser, loser. I mean, like every other year for a while was winner, loser, but the winners were bigger than the losers, right? Look at those winning years swallowing up. Look at 2021, massive. It's 20K account, we're over about 15, 16,000, right? Another huge winner in 2024, and it's not doing well in 2025. 2025's market's pretty garbage if you're a stock trader especially, and look at that. So yeah, terrible. Okay, so now we have 3. Nope, we're not there yet. Let's look at the curve. Sorry, 2002, 25. You see lots of jaggedy down over here, but it takes off when the trends are there. When the average true range rises on this, you also do well because that 1,000 will get hit real fast. Okay. Now, what if we put those 3 together? What would you expect? 3 different time frames, different methodologies. Now, the margin is around, again, your broker, you'd have to talk to them or at least look it up. The margin of trade station is about 15,000. Means you have to have 15,000 in your account to trade this, just one of them. Well, if you do 3 of them, we have 3 systems, that's 45. But what are the chances that all 3 of these are going to be in a trade at the same time? The first 2 are kind of similar, so there's a chance they both could be in, but the first daily system gets out pretty fast, right? We just need one RSI move. So the chance of those being in a trade, they're kind of, but the chance of this 5-minute trade, it's usually over in the same day. What are the chances that all 3 will be in a trade at the same time? Not great, not very high. So I did a portfolio of 36,000, okay? All that means is that I tried to account for at least 2 of them being in the market. That'd be about 30, and I went above that, okay? Do you run the risk of being in all three and maybe not having enough margin to take the next trade? Sure. Could you just make this 45? Sure. Again, that's something that you can decide. But for me, this seems very, very fair after looking at this, that we'd probably only be in two at a time. If so, here are the numbers, 296,000, very nice. Profit factor is now super nice, right? Love 1.5 and above, love that. Drawdown, again, close to close. And our profitable trades overall, now 42%. I mean, like it higher. I like the first two better, but oh, all right, that's fine. And now look at our annual, right? Huge in 2003, we survived 2008, little down in 2010, sneaky bearish year. 2010 was a bad year. People don't remember that either. But look at what we have here. On a hypothetical 36K account, we're at $47,000 in a single year. So even if you did $45,000 account, that's 100% win. Oh, and the next year was even bigger. Oh, and it did it again in 2024. Last year was a monster winner for these three. And they all work together nicely. 2025 is down because only the 5 minute has taken any trades. So is that a long-term system? Did multiple time frames work? What do you think? I mean, that's from 2002 all the way to 2025. That is a lot of years. It's more than 2 decades, right? That's 23 years-ish, right? It's over 20 years. Okay. And here's the equity curve. Now, if you start again, we would have gone underwater. Don't trade during the dot-com crisis. That's the number one thing I can give you today. But overall, using that size of account, it's well over 800% return. What about buy and hold? Buy and hold from January, including dividends, from 1/2/2002 to 2025, 629. We're well over 800% here, 629 there, if you just bought and held. Just throwing that out there, okay? So we'll summarize it, the 3 ways to trade an index. It's a nice amount of hypothetical profit. Again, I'm tracking this monthly. Does have losing years, just like index trading does, right? If you trade an index, it loses. Oh, look, lose, right? But it also has potentially 100% winning years, and indexing definitely does not do that. You will never get a 100% winner. I'm going on record. If you're trading an index, you're never getting 100% here, ever. And this one does. So what do you think of that? But now we're going to bring it home with gold. Okay, last thing. What about gold? What is gold supposed to do when the market is down like it is this year? Right? What has gold done in 2025? Well, here's the GLD ETF. I think it's done very, very well when markets are going down, because here's the SPY. Pretty garbagey, even though it's up today. So yes, gold is a great idea. What if we added gold? Wouldn't that potentially work very well? Let's find out. Here's the system. We're using Bollinger Bands trademark. They're my favorite way to trade breakouts, and I feel like they're superior. I've done the studies. Here's your system. 120-minute chart on the GC contract. Length of the Bollinger Bands is huge, 100. Standard deviation up is 2. That's normal. And oh no, did my screen go blank? That was fun. Standard deviation is up 2, and the standard deviation down is -3. They're not the same. That's bad. But the take profit is 3,000, and the stop loss is $1,000 per contract. That's a positive reward to risk, right? And here is your breakout trades, right? It closes above the bands. We go for our profit target. It didn't. This is March 2025. It goes above the bands, winner. Above the bands, closes above, winner. Stop out here, winner. And we just had a stop out, okay? So definitely gold has been breaking out this year, and we've caught some of that with this system. Here's the gold report from 2002 all the way to 2025. Again, this is just $15,000. You look up your broker, and you say, how much margin can I get? And for TradeStation, it's $15,000. So on a $15,000 account, I mean, this is massive numbers right here. $187,000, just gold. 187, look at that profit factor, excellent, right? I love over 1.3 for systems, 1.5 is great, 1.44 is right in the ballpark. Reasonable amount of drawdown, close to close. 34%, which you'd expect, right? We have a 3-to-1 reward to risk, so we'd expect that, right? But let's take a look and see what the yearly are. since 2002, and it wasn't all of 2002, keep that in mind. But winning, massive winning year in 2011, winning, and then back to back. So that stinks, but it's tiny. If this is just a part of the team, this is not hurting the team really at all. And we have all of these big wins potentially ready to help us when things are moving well for gold. 15K account, again, that's 100%, about 100%, way over 100%, right? Almost 200%. Small year, right? Loss. How's it been doing lately? Great. How's it been doing in 2025? How would you expect? Pretty great, right? Here's the curve for just gold, one contract, 15 grand. I mean, that's pretty steady. I mean, isn't that what we want on a simple Bollinger Band breakout system? We're just trying to have gold or trade gold when gold is moving, right? And we're trying to take more long trades and short according to our Bollinger Bands. So last thing, we'll put all four together. What do you get? Big numbers, right? This is why I track this portfolio every month. This is why I offer it for sale if I have TradeStation. On a 46K account, again, I added 2 ES plus gold. So 15 plus 15 plus 15 is about 45. So I did 46. You could raise that up to 57 if you want to get them all, right? But 484,000, look at our profit factor. Drawdown is very, very reasonable. Our profitable trades are at 40%. Trading them all together, pretty great. And look at what we have here. 2002 is not a full year. I throw that out. There are no losing years. Crazy, right? Did our methodology make sense? Did we put the puzzle pieces together? Massive winning years since 2020. Massive winning year in 2024. And it's up because of gold. Put them all together, the gold has done better than the little 5-minute chart. And here's your curve, right? We're over 1,000%. Remember, the market was about 600 and something, right? 629 to be precise. So in wrapping up, I wanted something that made sense. It could be traded long term. What do we have? We have the market, the stock market with leverage and futures, 3 different methodologies, 3 different time frames, and we have gold, right? It's been working ever since I tested it. Seems to be working great. So hopefully it will continue.